In today's video, I'll be showing you the 2025 tax changes that every small business owner needs to know. As a registered CPA and owner of a tax technology company, TaxHelm, I've seen firsthand how important it is to understand yearly tax changes. And that's exactly why I'm making this video today, to break down these changes and help you further optimize your 2025 tax plan. All right, so let's dive into it. There's 5 kind of topics that I want to focus on today. And the first one is tax bracket changes. And these are changes that happen every single year where the tax brackets shift. And so I just want to kind of walk through what are those changes for those that are single and for those that are filing married. And I'm going to kind of generalize these. They're very specific numbers, but I'm going to just kind of round up to make it easier for this purposes. So if you're single and you're making any funds that you earn under $12,000 are going to be taxed at 10%. $12,000 to $48,500 taxed at 12%. $48,500 to $103,000 is taxed at 22%. The 24% tax bracket will be income that you earn from $103,000 to $197,000. And the income in the 32% tax bracket is going to be $197,000 to $250,000. 35% tax bracket is $250,000 to $626,000. And then once your income tops $626,000, any income above that is going to be taxed at the 37% tax bracket. Now, there is a lot of confusion when it comes to these types of tax brackets. And so basically, the way that tax brackets work is that your income in between the inside of a tax bracket is taxed at that. So let's say the 37% tax bracket is $626,000 for a single filer. And let's say that you make $630,000. Now, some people think that if you make $630,000, all of your income is taxed at 37%. And that's not the case. You're going to have some of your income taxed at 10%, some at 12, 22, 24, 32, 35%. And then just the amount that's over the $626,000 of the 37% tax bracket is going to be taxed at 37%. So if you make $630,000, that means only $4,000 is going to be taxed at that 37% tax bracket, and the rest is taxed at other ones. So simply by going into a tax bracket by $1 does not mean that all of your income is jumping up. And this is something that is confusing for a lot of people. And I just want to kind of outline that because I've heard from so many people that say, I don't want a bonus from work because it's going to jump me into the next tax bracket. And in some instances, we might analyze that, but generally stating for this purposes, that doesn't matter. Sure, you might jump into that next tax bracket and you might have some funds taxed at a higher rate, but that does not mean that all of your income gets jumped up. So those are the brackets for single. Now, if you're married, brackets are going to be roughly doubled. So the 10% tax bracket is going to be any income that you earn from $0 to $24,000. The 12% tax bracket is $24,000 to $97,000. The 22% tax bracket is $97,000 to $207,000. 24 is $207,000 to $395,000. 32% tax bracket is $395,000 to $500,000. The 35% tax bracket is $500,000 to $752,000. And then any income you earn above $752,000 is taxed at that 37% tax bracket. So let's talk about this. Why do these changes occur? And in most of the things that we talk about today, the reason they change these brackets is for inflation. Because you imagine, let's say they set these tax brackets 12, 15, 25 years ago. The income levels and due to inflation, we're making a lot more money now, but everything's costing more as well. So it's not like we're making more and everything costs the same. All the costs and all the income traditionally is going up by an inflation rate. And so they adjust these brackets every single year. But this is good news. This is good news. That means that more of your income is going to be taxed at a lower rate than what it was last year. If they wouldn't have changed these, you would have likely paid more in taxes. But let's talk about why it's important to understand these tax brackets and how we plan around it. And so I had a situation the other day where I was talking with somebody that was looking to do a Roth conversion, and they were in the 24% tax bracket, and they were trying to determine how much should I convert. And so we said, well, let's maximize up to the top of that 24% tax bracket. Let's not go into the 32% tax bracket because now we're paying unnecessary taxes on a Roth conversion that if we did a portion of your Roth conversion today, this year, up to that top of that tax bracket. And then next year, when you're still in that tax bracket, we can go to the top of that tax bracket again. And there we would save, let's say you were in the 24% tax bracket, we would make sure that all of it's taxed at 24% and none of it at 32%. Because if you jump from that tax bracket, that's a big jump. That's an 8% increase. And so Let's say that you were going to do a Roth conversion of $100,000 and 50 was going to be taxed at 24 and the other 50 was going to be taxed at 32. We definitely would want to say, okay, let's hold off on that 50 that's going to be taxed at 32% and let's wait till next year and do it when we're back again, we reset and we're back in that 24% tax bracket, because we're saving 8% in taxes on that at that time. So there's a lot of planning that we want to do with tax brackets. It's important to understand, where are you on that tax bracket map? So kind of where do you plan to fall? Because that's going to associate what type of planning that you want to do. And that oftentimes determines, for every additional business deduction we have, how much are we saving? So if we have income in the 37% tax bracket or the 35% tax bracket or the 32% tax bracket, and we're reducing income, that means that every dollar we spend, if we're in the 32% tax bracket, every dollar that we spend in that tax bracket, we're saving 32 cents. So that's the type of planning that we can do once we kind of know these tax brackets. So let's talk about the other items. So tax brackets is number one. Those are big changes that we've made for single and then married, in why it's important. The second thing that's changed for 2025 is business mileage. So you know that if you take the mileage method when you're taking the automobile deduction, you can take an X amount of dollars or cents per mile driven. And in 2024, that was 67 cents. In 2025, that's 70 cents. So that's great. You get more cents and more of a deduction, 70 cents per mile in 2025. Again, why this change? Again, it comes down to inflation. Things are costing more, and so they're adjusting these numbers. And this is a good thing. We want them to adjust. And it's a good thing, especially when they're adjusting up. So how do we plan around this? First off, we just want to continue to always run the numbers. If you're buying a new vehicle, we want to run those numbers. Does actual expenses make sense? And actual expenses, when we take the automobile deduction, is where we're taking depreciation on that automobile, all the gas, repairs and maintenance. We're taking the actual costs of those, and we're getting a deduction for our business use percentage of that. Where if we go the mileage method, that gas, that depreciation, we don't get any deduction for that. We just get the 70 cents in 2025 per mile deduction for that. So we want to continue to run that planning, and generally saying super expensive cars, typically we're going to lean toward the actual method. But let's say you bought a very cheaper, reasonable car and you're putting a lot of miles on it. Let's say you bought a vehicle for $20,000, but you're putting 10, 20,000 miles on it per year. We're probably going to lean towards the mileage method, because we're going to get a much bigger deduction over time by doing that mileage method. So we want to do the analysis. What's the car? Let's run some analysis. How much are you spending? How many miles are you putting on it? And let's determine for that new vehicle that you buy in 2025, should we go with the actual method or should we go with the mileage method, while also looking forward to and thinking, what does this mean for future years as well? Now, since I can only cover this tax change in so much detail here, I don't want you to walk away from this video and fall into what I like to call the generalized content trap, where you never get advice that applies directly to your situation. And especially, with the start of 2025, it's crucial you make sure that your tax plan is fully ready. So for you, right now, I want to offer you a complimentary demo call where we'll look at your exact situation and help you come up with a game plan for your taxes here in 2025. You can book a demo call at TaxElm by going directly in the link in the show notes, clicking that link, book your free TaxElm demo call now. So number two item that we talked about was the mileage deduction going up to 70% per mile in 2025. The next thing we want to talk about is the standard deduction. And you'll know that with the Tax Cuts and Jobs Act back in 2017, the standard deduction was significantly increased. And what that meant is that for most taxpayers, instead of taking or determining, do I take the standard deduction or do I itemize my deductions, most taxpayers have been falling into the standard deduction. And basically what that means is it's a straight deduction off of your income. And so in 2025, that change, if you're married, that standard deduction went up to $30,000. That's up from $29,200, an $800 increase from 2024. Now, if you're single, it's half of that. So the standard deduction for a single payer is $15,000, up from $14,600, a $400 increase. Again, these are changed because of inflation. But what does this mean? We need to still always analyze, do we itemize deduction or we do a standard deduction? And again, because the standard deduction is so high, more often than not, we see the average small business owner, the average taxpayer, taking the standard deduction. And what does that mean? It means that your itemized deductions don't come into play. That $1,000 that you gave to charity, you may not get a deduction. You may not see a tax benefit from that if you're taking the standard deduction. Those real estate the property mortgage interest that you're paying, those real estate taxes, you might not get a tax deduction if you're just taking the standard deduction. And so I actually had a call the other day with someone that said, I forgot to pay my taxes on 12/31. Is there any way I can backdate that? And I said, unfortunately, no, that's going to be a 2025 situation. But I said, looking at your situation, you've always taken the standard deduction. So that change in those real estate taxes that you pay, whether it's in 2024 or 2025, will not impact that anyways, because you're still going to take the standard deduction. Now, other times we see people where they're typically going to be a standard deduction, but they want to take advantage of this itemized deduction. So they'll bunch itemized deductions in a specific year. Let's say that you want to give to charity. And let's just say that you gave the charity on average $10,000 per year. Well, instead of giving $10,000 per year and getting that $10,000 that maybe you're still going to take the standard deduction anyways and get no true benefit for that gift to charity from a tax standpoint, maybe instead you prepay 1 year. So you're going to pay $20,000 in 1 year. You're going to pay $10,000 for this year and $10,000 for the next year, but you're just going to prepay that $10,000 for next year. That's this idea or concept of bunching itemized deductions to help take advantage of that itemized deduction. So that year that you bunch, you're going to take the itemized deduction because it's definitely going to be a benefit for you. But in that year that you're not bunching, so it's going to be an every year type thing, in that year that you're not bunching, you're probably just taking the standard deduction. So there is a lot of planning that we can do around the standard deduction, but just know standard deduction for 2025, married is $30,000. If you're single, $15,000. All right, so let's talk about item number 4. Some new retirement contribution limits. And this is good news again. So what is the change? 401k employee contributions is at $23,500 for 2025. That's up from $23,000 in 2024. So $500 more that you can put towards retirement as an employee. Now, IRA contributions, so think of just a traditional IRA or a Roth IRA, those remain at $7,000. Why the IRS decided not to increase that for inflation, I don't know. But that stayed at $7,000. Again, the typical change for these increasing these amounts is again comes back to this idea of inflation and costs going up and income going up and adjusting for that. So it's a good thing that we're always adjusting these. Again, hopefully they're always going up. So for 2025, the max you can put into a 401k as an employee is $23,500, $500 more than you could have done in 2024. So when we look at this from a business owner's aspect, why is this important? What kind of planning can we do around this? Well, if you're short on retirement funds and you want to continue to fund a 401k and max out retirement as much as possible in the most tax advantaged way, you now have more money that you can put towards retirement. So again, we want to do some analysis of where are you at from a retirement standpoint? Where do you want to be? And what do we need to do to get there? And if we're looking from it from a tax perspective, or if we're looking from a retirement number perspective, whatever it might be, now we know that in 2025, that number went up. Finally, item number 5. And this is one that I like to talk about, but also can be a hard one to talk about with certain people. And that's the gift tax and estate tax. So first off, let's talk about that. What is the gift tax exclusion? Basically, the IRS gives you a number that says you can gift up to this amount per year, and you don't have to report it. You don't have to worry about it. It's not income. You don't have to file a gift tax return. You don't have to do anything. And that number for 2025 is $19,000. That's up $1,000 from last year, 2024, which was $18,000. So the gift tax exclusion is $19,000 for 2025. That means that you can gift up to $19,000 and not have to file per person and not have to file any kind of gift tax return or worry about anything like that. Now let's talk about estate tax. This is that exclusion that if you hit this number, you start to have a taxable estate. What does that mean? That if you pass away and your net worth, what you're passing on to your heirs, is over this number, there's going to be some tax that your heirs are going to have to pay on that unless you do some proper planning for that. And the estate tax number for 2025 is $13.99 million. That's up from $13.61 million in 2024. So just under $14 million. That means if you have a taxable estate, if you have a net worth, or you plan to have a net worth of over $14 million, I would start to reach out and find out what kind of planning can we do so that in the unfortunate event of a death, how do we avoid paying a good portion of our net worth to the government? So that's when planning starts to come in there. Again, why are these changes? Why this increase? Inflation, different adjustments for that. But let's talk about this gift tax, because that's one that's important. That's one that comes into play with everybody potentially every year in this $19,000 limit. Let's say that you were potentially going to be going up to that estate tax limit, or you want to try to avoid it. you might start to say, hey, I'm going to start gifting some things to my family here now while I'm still alive. But you want to make sure that you stay under that gift tax amount, because once you go over that $19,000 in gift tax per year per person, now you have to start filing a gift tax return. That's no problem, but it starts to eat away at that 13.99 million, where if we don't jump over that 19, we don't have to file that gift tax return, and it has no effect, doesn't eat into that 13.99 million at all. So what are some planning that we can do around that? Well, maybe you're looking to give away some of your assets. Maybe you're looking to start to transition your business away into some family members. Well, you could transition up to $19,000 per person per year, at least in 2025 rates, without any kind of worries about that. Now, that $19,000 is per person. So if you're gifting to a married couple, let's say it's your son or your daughter, you would have a $19,000 you can give to your son or your daughter, and then you have another $19,000 that you can give to their spouse. You could also give to their children, $19,000 for children one, children two. So there is a lot of opportunity where you could take away a lot of your assets and your earnings that you could give away in a gift without having to even worry about that estate tax limits. So there's a lot of planning that we can do around that. Okay, now I want to kind of take all this and kind of put it into a picture that explains exactly what does this mean for 2025. Again, number one is the tax brackets have increased. So definitely check out whether you're single or you're married. Look at where your tax brackets are. Understand where you land on that tax bracket picture, because that's going to help evolve into sort of understanding what type of planning that you might want to do. Number two, business mileage increase. So for 2025, it's 70 cents per mile. That's up from 67 cents per mile in 2024. The standard deduction has increased. If you're married, the standard deduction now is $30,000. If you're single, it's $15,000. You want to analyze that and look at your itemized deductions and see how that can impact you. There's new retirement contribution limits. Your 401k employee contributions for 2025, the max you can put into that 401k as an employee is $23,500. That's up $23,000 from 2024. Now, IRA contributions, again, that number didn't change. Why? We don't know, but that number is still $7,000. So that traditional IRA, Roth IRA, maximum amount per person in there is $7,000. And then the gift and estate tax. The gift tax exclusion went up to $19,000 in 2025. That's up from $18,000 in 2024. And the estate tax is $13.99 million, where you start to have, if you're above that with a net worth, when you pass away, you start to have a taxable estate at that point. Now, key items to think about. This is for tax year 2025. So we're in 2025 now. You're going to be, I don't want you to be confused, because you're probably looking to start filing your 2024 tax filings, last year's tax filings. You're working about filing that. Those are 2024 numbers. So what we're talking about today are 2025 numbers. That's for this year and moving forward. This is going to be for the tax return that you file next tax season. So just keep that in mind. The second piece I want to talk about is that we have a new administration coming into office, and that's going to impact things. There's likely going to be some sort of tax bill change, different types of tax adjustments from that. There is a lot of the items from the Tax Cuts and Jobs Act back in the previous Trump administration are set to expire coming up. So there will likely be some major tax impacts and some major tax changes with this new administration coming in. And so I just want to say, keep abreast of that. Keep up to date on those different things. Follow us. We're going to be giving you live updates as we get these adjustments, as we get these changes, whenever they come. We don't know. Maybe they come here in 2025. Maybe they come early 2026. We don't know for sure. But stay tuned and stay subscribed to our channel so that any kind of changes in tax law, you are getting live updates on that. So now that you understand the 2025 tax changes that every small business owner needs to know, you need to understand one thing. This is just one piece of the puzzle when it comes to building a successful 2025 tax plan. You know, after analyzing thousands of tax plans, I've discovered that what matters most is the advice you listen to when creating your tax plan. And because it's so easy to fall into the generalized content trap, where you never get actionable advice that's tailored to your situation, I want to offer you a complimentary demo call where I'll analyze your situation and help you fully optimize your tax plan directly with Tax Help. Just click the link in the show notes below to schedule a time and book a free Tax Help demo. Thanks for joining, and I'll see you on the next one.